Look at your silver chart right now. See those Bollinger Bands? They're tighter than they've been in 18 months. And if you understand what that means, you know exactly what's coming next. Let me explain something about Bollinger Bands that most people miss. When those bands squeeze together like this, it's not just a technical pattern. It's the market coiling up like a spring. All that energy, all that indecision, all that pressure building up in the background, it's about to release. And when it does, silver doesn't move in inches. It moves in dollars. The last time we saw a squeeze this tight was March 2023. Silver was trading at $20.50. Within 6 weeks, it had rocketed to $26.15. That's a 27% move in less than 2 months. Before that, September 2022. Silver went from $17.80 to $24.50 in 3 months. Every single time these bands compress like this, silver explodes. The only question is which direction. But here's what makes this squeeze different. This time, we're not sitting in a vacuum. We're sitting on top of the most bullish fundamental setup silver has seen in 40 years. Start with the supply side. Mexico just announced their silver production dropped 8% year over year. That's Mexico, the world's largest silver producer, pumping out less metal. Peru, number 2 on the list, down 6%. Bolivia, down 11%. We're talking about the 3 biggest sources of new silver supply all contracting at the same time. And it's not temporary. These aren't strikes or weather delays. These are depleting ore grades and aging mines that can't be replaced fast enough. The Silver Institute released their numbers last month. Global silver mine supply, down for the 3rd consecutive year. Total available supply including recycling, barely keeping pace with industrial demand alone. That's before you count investment demand, before you count the 300 million ounces that went into solar panels last year, before you count the surge in electrical vehicle production that requires twice as much silver per unit as traditional cars. Now layer on what's happening in the physical market. The U.S. Mint sold 4.2 million Silver Eagles in October. That's the highest monthly total since 2015. They're rationing dealer allocations because they can't keep up with demand. The Royal Canadian Mint, same story. Perth Mint in Australia, same story. Premiums on physical silver coins are running $6 to $8 over spot. When was the last time you saw premiums that high? 2020, right before silver went from $18 to $30. But here's where it gets really interesting. Look at what the big money is doing. The silver ETFs, the ones that actually hold physical metal, they've added 42 million ounces in the last 90 days. That's institutional money. That's not retail investors buying a few coins. That's funds, family offices, and wealth managers accumulating size. And they're doing it quietly, before the breakout happens. Check the COMEX warehouse stocks. Total registered silver, the stuff actually available for delivery, sitting at 71 million ounces. Sounds like a lot, until you realize that's only about $2.4 billion worth of metal backing a derivatives market with over $100 billion in open interest. The ratio of paper silver to physical silver available for delivery is running at 140 to 1. That's not a market. That's a powder keg. And the commercial traders, the big banks and mining companies that usually suppress silver prices, they've flipped. For the first time in 3 years, the commercials are net long silver futures. They're not fighting the rally anymore. They're positioned for it. When the smart money that usually caps silver prices suddenly switches sides, you need to pay attention. Now let's talk about what's driving this from the macro side. The Federal Reserve just pivoted. After hiking rates for 2 years straight, they've started cutting. And every single time in history that the Fed has started a rate-cutting cycle, silver has rallied. Not sometimes, every time. Because lower rates make holding non-yielding assets like silver more attractive. Because lower rates typically weaken the dollar. And because lower rates usually signal economic trouble ahead, which drives safe haven demand. Look at the dollar index. It's rolling over. Peaked at 107 in October, now trading at 104 and change. That's a 3% drop in 6 weeks. Doesn't sound like much until you realize silver is priced in dollars. Every percentage point the dollar falls typically translates to a 2 to 3% gain in silver prices. We're talking about a currency that's been overvalued for 2 years, finally starting to normalize. And as it does, silver gets repriced higher. But the real story, the one nobody's talking about enough, is what's happening with industrial demand. Silver isn't just a monetary metal anymore. It's the most conductive element on Earth. It's irreplaceable in electronics, solar panels, 5G infrastructure, electric vehicles, and medical applications. And all of those sectors are exploding. Solar panel installations are projected to double by 2027. Each panel requires about 20 grams of silver. That's an additional 200 million ounces of annual demand coming online in the next 3 years. The electric vehicle market is growing at 25% per year. Each EV uses 25 to 50 grams of silver depending on the model. That's another 100 million ounces of new demand by 2026. 5G infrastructure build-out requires 3 to 4 times more silver per cell tower than 4G. We're talking about hundreds of millions of ounces of structural demand that didn't exist 5 years ago. And here's the kicker. None of that demand is price sensitive. Solar companies don't stop building panels because silver goes from $25 to $35. The silver cost per panel is negligible compared to the total unit cost. EV manufacturers don't redesign their electrical systems because silver prices doubled. They can't. There's no substitute that works as well. This is inelastic demand meeting constrained supply. Economics 101 tells you what happens next. Let me tell you about what happened in 2010 and 2011, because we're seeing the exact same setup. Back then, silver was trading around $18. The Bollinger Bands squeezed tight, just like now. Industrial demand was surging from the smartphone revolution. Mine supply was flat. The dollar was weakening, and silver went from $18 to $49 in less than a year. That's a 172% gain. People who understood the setup and positioned early made life-changing money. Now, I'm not saying we're going to $49 tomorrow, but I am saying the fundamental setup is stronger now than it was then. The supply deficit is worse. The industrial demand drivers are bigger. The monetary environment is more favorable. And the technical setup, with these Bollinger Bands squeezed this tight, is screaming that a major move is imminent. Here's what most people miss about silver. It's not like gold. Gold moves in a steady, predictable way. Silver is volatile. It sits quiet for months, even years, while pressure builds. Then it explodes. In 2010, silver gained 83% in 12 months. In 2020, it gained 67% in 5 months. In 1979, it went from $6 to $50 in less than a year. Silver doesn't give you slow, steady gains. It gives you explosive moves that happen fast and catch most people off guard. And right now, with these Bollinger Bands compressed like this, we're in the calm before the storm. The market is telling you something big is about to happen. The fundamentals are confirming it. The question is whether you're positioned before it breaks. Quick aside here because this is relevant. If you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold and silver IRAs work. It's in the description below. Covers how to get physical precious metals into your retirement account without tax penalties, how the process works, what the costs are. Worth checking out if you're thinking about protecting some of your retirement savings with hard assets. Anyway, back to where this price is headed. Let's talk about the geopolitical angle, because it matters more than most people realize. The BRICS nations, Brazil, Russia, India, China, South Africa, they're actively working to reduce their dependence on the US dollar. They're settling trade in local currencies, they're accumulating gold and silver reserves, they're building alternative payment systems. And as they do, the demand for physical precious metals as a neutral reserve asset is increasing. China's been on a buying spree. Their silver imports hit a 5-year high last quarter. They're not buying silver to sit on it. They're buying it because their industrial sector needs it, and because they see the supply crunch coming. When the world's largest manufacturer of electronics, solar panels, and EVs is stockpiling silver, that tells you something about where they think prices are going. India is another massive player. Silver demand in India jumped 18% last year. That's a cultural thing. Indians buy silver for weddings, festivals, and as a store of wealth. But it's also an industrial thing. India's manufacturing sector is booming as companies diversify away from China. More manufacturing means more silver demand. And India's not slowing down. Then you've got the central banks. While everyone focuses on their gold purchases, they're quietly accumulating silver too. Not in the same quantities, but the trend is there. Why? Because silver is undervalued relative to gold. The gold-to-silver ratio is sitting around 88 to 1. Historically, it averages 60 to 1. That means silver is 30% cheaper relative to gold than it should be. Central banks understand value. They're accumulating the undervalued asset. Now let's talk about what happens when these Bollinger Bands actually break. Because they will break. They always do. The question is, which direction and how far? Technically, silver is sitting right at a critical level. The 200-day moving average is at $28.50. We're trading just below it. If silver breaks above that level with conviction, the next resistance isn't until $32. That's a 13% move with very little standing in the way. Above $32, you're looking at $35, which was the 2021 high. Break that, and there's no meaningful resistance until $40. On the downside, support is at $26.50, then $25. But here's the thing. The fundamentals don't support a breakdown. The supply deficit is real. The industrial demand is real. The monetary environment is favorable. A breakdown would require a major shift in the macro picture. A sudden dollar surge, a collapse in industrial demand, a flood of new supply. None of those things are on the horizon. So, the risk-reward here is asymmetric. Downside is maybe 10% to strong support levels. Upside is 30 to 50% to previous highs, and potentially much more if we get a real momentum move like 2010, 2011. That's the kind of setup professional traders dream about. Let me tell you about a guy I know who trades silver for a living. He's been doing this for 20 years. He told me something that stuck with me. He said, silver gives you maybe 3 or 4 really big opportunities per decade. The rest of the time it's choppy and frustrating. But when those opportunities come, when the fundamentals align and the technicals confirm, you have to go big. Because those moves pay for years of patience. We're in one of those moments right now. The Bollinger Band squeeze is the technical confirmation. The supply deficit is the fundamental driver. The monetary environment is the macro tailwind. And the industrial demand surge is the structural support. All the pieces are in place. Think about what's happened in the last 6 months. Silver bottomed at $22.50 in February. It rallied to $32 in May. Then it pulled back and consolidated for 6 months, building this tight range between $27 and $30. That consolidation, that's not weakness. That's the market digesting the gains and building energy for the next leg up. And now, with the Bollinger Bands squeezed this tight, that energy is about to release. Look at the volume patterns. During the consolidation, volume has been declining. That's classic. The market is losing interest, getting bored, shaking out the weak hands. But in the last 2 weeks, volume has started picking up. Big volume days on up moves, light volume on down moves. That's accumulation. That's smart money quietly building positions before the breakout. Check the options market. Call option volume on silver futures has jumped 40% in the last month. Open interest in out-of-the-money calls is at a 2-year high. The options market is pricing in a significant probability of a major move higher. And options traders, especially the institutional ones, they don't throw money at long-shot bets unless they see something coming. Now let's talk about the mining stocks, because they're giving us another signal. The silver miners, companies like First Majestic, Hecla, Coeur, they've been outperforming the metal itself. When mining stocks lead the metal higher, that's bullish. It means the market is anticipating higher silver prices and pricing it into the equities first. The miners are up 15–20% in the last 2 months, while silver is only up 5%. That divergence doesn't last. Either the miners come back down or silver catches up. Given the fundamentals, silver is catching up. Here's something else that's fascinating. The silver-to-gold ratio, which I mentioned earlier, it's starting to compress. 3 months ago, it took 92 ounces of silver to buy 1 ounce of gold. Today it takes 88. That ratio is moving in silver's favor. And historically, when that ratio starts compressing, it accelerates. We've seen it drop from 90 to 60 in a matter of months during previous silver bull runs. If that happens again, we're talking about a 30% outperformance of silver versus gold, and gold is already in a bull market. Let me paint you a picture of what the next 6 months could look like. Silver breaks above $30 on strong volume. The Bollinger Bands expand. Momentum traders pile in. The move accelerates to $32, then $35. Industrial buyers who've been waiting on the sidelines start panic buying because they need the metal for production. That pushes prices to $38, $40. Retail investors finally notice. Silver is all over financial media. FOMO kicks in. We hit $45, $50. The mining stocks triple. Everyone who positioned early is sitting on massive gains. Is that guaranteed? No. Nothing in markets is guaranteed. But is it probable, based on the technical setup, the fundamental drivers, and historical precedent? Absolutely. The pieces are all in place. The Bollinger Band squeeze is just the final signal that the move is imminent. Now think about the alternative scenario. You wait. You want more confirmation. Silver breaks out to $32, then $35. You finally buy at $36, thinking you're getting in on the momentum. Then it pulls back to $33 and you panic sell. You end up losing money on a trade that could have made you 50% if you'd positioned before the breakout instead of chasing it. That's what happens to most people. They wait for confirmation, which means they wait for the move to already be underway. Then they buy high, get shaken out on the first pullback, and miss the real gains. The time to position is before the breakout, when the setup is clear but the move hasn't happened yet. That's when the risk-reward is most favorable. Look at what happened in 2020. Silver was trading at $18 in March. The Bollinger Bands were squeezed tight. The fundamentals were bullish, but everyone was scared because of COVID. The people who bought at $18 made 67% when silver hit $30 by August. The people who waited for confirmation bought at $24, got scared when it pulled back to $22, and sold for a loss. Same setup, different outcomes based on timing. We're in that pre-breakout moment right now. The Bollinger Bands are squeezed. The fundamentals are bullish. The macro environment is favorable. The technical indicators are aligning, and most people are still sitting on the sidelines waiting for confirmation. That's your opportunity. Here's what I'm watching for in the next few weeks. First, a decisive break above $29.50 on strong volume. That would confirm the upside breakout. Second, the dollar index breaking below 103. That would remove a major headwind for silver. Third, continued strength in the mining stocks. If they keep outperforming, it confirms the institutional money is positioning for higher prices. And fourth, any news on the supply side. Another major mine closure, another production cut. Anything that tightens the physical market further. Any one of those catalysts could be the spark that ignites this move. All four together, and we're looking at an explosive rally that catches most people off guard. Think about your own situation for a moment. If silver goes from $28 to $42 over the next 6 months, that's a 50% gain. On a $10,000 position, that's $5,000. On a $50,000 position, that's $25,000. On a $100,000 position, that's $50,000. Those aren't hypothetical numbers. That's what happened in 2020. That's what happened in 2010, 2011. That's what happens when silver breaks out of a tight consolidation with strong fundamentals behind it. And here's the thing about silver that makes it different from almost any other asset. The moves happen fast. You don't have years to position. You have weeks, maybe months. Once the breakout happens, once momentum kicks in, the easy money gets made quickly. Then it consolidates again, and you wait for the next setup. But right now, right here, with these Bollinger Bands squeezed this tight, we're in that pre-breakout window. The supply deficit isn't going away. Mines take 7 to 10 years to develop. Even if silver hits $50, you're not going to see a flood of new supply for years. The industrial demand isn't going away. Solar, EVs, 5G. These are multi-decade trends that are just getting started. The monetary environment isn't going away. The Fed is cutting rates, the dollar is weakening, and inflation is still above target. All of those factors support higher silver prices. What we're seeing right now is the market recognizing all of this and coiling up before the move. The Bollinger Band squeeze is just the technical manifestation of that coiling process. And when it releases, when those bands expand and silver breaks out, the move is going to be fast and powerful. So here's my question for you. Are you going to position before the breakout? Or are you going to wait for confirmation and chase the move? Are you going to take advantage of this setup while the risk-reward is favorable? Or are you going to watch from the sidelines and wish you'd acted? Because this Bollinger Band squeeze is telling you something. The market is about to move. The only question is whether you're ready for it.